Welcome back to the Daily Crypto Roundup. Today's episode is about understanding where we are now, not reacting to where we were yesterday. Over the last 24 hours, crypto markets have stopped accelerating lower and begun to stabilize. Bitcoin dipped below the 90,000 level earlier, but since then, price action has slowed, ranges have tightened, and the market has shifted from panic into assessment. Ethereum has cooled back toward 3,000. But without the kind of follow-through you'd expect if this move was turning into something more aggressive. Altcoins remain under pressure, but again, the character of the selling has changed. So today we're going to take a step back. We'll walk through where prices are sitting right now, then we'll break down what actually drove this move, what acted as the trigger versus what was already building under the surface, and why the market response over the last 24 hours looks different to the initial flush. We'll look at capital flows, ETF behavior, sentiment, and how crypto is being treated in the current macro environment compared to traditional safe havens like gold and silver. This isn't about calling tops or bottoms. It's not about panic, and it's not about blind optimism either. It's about context, structure, and understanding how markets behave when risk gets repriced and then pauses to find balance. And before we get into it, a quick reminder. We're still running the XRP giveaway. If you've got thoughts on today's move or where you think the market goes next, drop a comment and you'll be in the mix. Let's start with where prices are actually sitting right now. Bitcoin is trading around $87,711, having stabilized after the earlier move lower and spending the last session in a sideways range rather than accelerating down. Ethereum is near $2,866, still below recent highs, but holding key support rather than collapsing outright. BNB is around $870. XRP is near $1.88. Solana is about $126. Dogecoin is roughly 12 cents, and Cardano is around 35 cents, all reflecting a market that has pulled back but has not broken structure aggressively. Total crypto market capitalization is around $2.97 trillion, and Bitcoin dominance is sitting near 59%. Suggesting this move has been broad-based but contained. From a sentiment perspective, the Crypto Fear and Greed Index is currently reading in fear territory, indicating that market psychology remains cautious rather than euphoric, which historically can signal that a large portion of the selling pressure has already come through. When sentiment sits this low, it often points to emotional exhaustion rather than capitulation, adding context to why we've seen price action stabilize instead of break sharply lower. What's interesting about this phase of the market isn't just the price action, it's the behavior. Over the last 24 hours, we've seen a clear shift away from reaction and toward positioning. The initial move lower was fast, emotional, and driven by headlines. But what followed has been slower, more deliberate, and far more telling. When markets stabilize instead of cascading, it usually means the easy selling is done, and the next move depends on conviction rather than fear. One of the clearest signals of that is what long-term holders are doing. Despite the volatility, there hasn't been a surge of coins rushing onto exchanges. On-chain data continues to show that larger wallets, older coins, and long-term holders have largely stayed put. That matters, because in real breakdowns you usually see panic from every corner of the market. That hasn't happened here. What we've seen instead is short-term leverage getting flushed, weak hands getting forced out, and stronger hands waiting rather than chasing. This also lines up with how professional capital behaves during macro uncertainty. Funds don't usually exit all at once. They reduce exposure, reassess, and then wait for clarity. That's the environment we appear to be in right now. Price isn't exploding higher, but it's also not accelerating lower. It's pausing. And pauses after sharp moves are where the next trend is decided. That doesn't mean the danger is gone. It means the market has moved from shock to evaluation. And historically, this is the phase where narratives get rewritten. Extreme fear readings don't tell you price will bounce tomorrow, but they do tell you that emotion has already done a lot of the work. From here, direction will be set by macro follow-through, liquidity conditions, and whether buyers are willing to step in at these levels rather than waiting for perfect certainty. After briefly slipping below the $90,000 level, Bitcoin has spent much of the session holding in the high 80,000s, hovering around that 88 to 89 range. Ethereum has followed a similar pattern, sitting just under 3,000 without breaking down aggressively. Across the wider market, price action has slowed. Ranges have tightened. The pace of selling has eased. And that tells us something important about where we are in this move. A very interesting institutional development out of the digital asset world today comes from Mike Novogratz's Galaxy Digital. The firm has secured $100 million to launch a dedicated crypto hedge fund in the first quarter of 2026. Rather than sitting on the sidelines during the recent pullback, Galaxy is doubling down. The new fund will allocate roughly 30% of its capital into crypto tokens like Bitcoin, Ethereum, and potentially other major networks, while the remainder will be invested in financial services stocks and tech firms exposed to blockchain and digital finance trends. What's notable here isn't just the size of the fund, but the timing. This comes at a moment when prices are under pressure and volatility is back in markets. Galaxy's strategy, according to people familiar with the plan, is designed to profit in both rising and falling markets, using a mix of long and short positions. That kind of hybrid approach suggests they're thinking in terms of structural opportunity and macro dispersion, not just a speculative rebound. It also reinforces that institutional appetite hasn't evaporated entirely. Capital is still being put to work in digital assets and adjacent sectors, even as risk sentiment remains cautious. What we saw earlier in the week was a fast repricing driven by macro headlines and leverage. What we're seeing now looks more like a market taking stock. Volatility is still there, but it's no longer accelerating. That shift from momentum selling into consolidation is subtle, but it matters. It suggests that the forced part of the move may be behind us, at least for now. At the same time, there's been a very clear divergence across asset classes. While crypto pulled back, gold and silver continued to push higher. Estimates suggest around $150 billion has come off total crypto market capitalization during this move, while traditional safe havens caught bids. That tells you exactly how markets are framing the current environment. This isn't about crypto-specific failure. It's about risk being dialed down more broadly, with capital rotating into assets that historically benefit when uncertainty rises. That framing was echoed by comments coming out of Davos, where Anthony Scaramucci spoke about rising volatility as a structural feature of markets, rather than a temporary phase. He reiterated longer-term optimism on Bitcoin, but acknowledged that macro uncertainty, geopolitical risk, and shifting policy expectations are likely to keep volatility elevated. That's an important lens to keep in mind. It suggests moves like this are not anomalies. They're part of the backdrop we're operating in. Geopolitical headlines continue to play a role as well. Renewed tariff rhetoric and broader political tension have pushed markets into a more cautious stance. When those kinds of headlines hit, the first reaction is usually to reduce exposure to higher beta assets. Crypto still sits firmly in that category. So when risk sentiment wobbles, it tends to feel the pressure early. XRP has been caught up in that same dynamic. Over the last day, XRP outflows saw roughly $53 million from various ETF products, and price has struggled to hold the $2 area. That doesn't suggest anything uniquely broken about XRP. It reflects the reality that even liquid, well-followed assets get trimmed when funds reduce exposure across the board. Another significant story today is out of Binance, which has announced it will list RLUSD, a US dollar-backed stablecoin issued by a Ripple subsidiary, with spot trading set to open on January 22nd. Binance is rolling out multiple pairs and will run a zero-fee trading promotion on certain pairs at launch to encourage liquidity. RLUSD is fully backed one-to-one by US dollars, short-term treasuries, and cash equivalents, and listing on one of the largest exchanges in the world gives the token immediate visibility and tradability. This isn't just another stablecoin ticker. It's a sign of how stablecoins are diversifying beyond the longtime leaders like USDT and USDC, and how exchanges are willing to incentivize adoption. A broader stablecoin ecosystem can improve capital efficiency, facilitate cross-chain settlement, and provide alternative USD liquidity inside and outside DeFi. With this listing, Binance is directly boosting RLUSD's reach, while giving traders new ways to manage dollar exposure and move between stable assets and core tokens like XRP. It's also worth noting that not everything happening in the space is negative. Even in the middle of this pullback, we're still seeing development and expansion. Binance announced the listing of SKR, the token linked to Solana Mobile. That kind of news doesn't change market structure on its own, but it's a reminder that underlying ecosystem progress doesn't stop just because price cools. Across altcoins more generally, the picture remains mixed. XRP, Dogecoin, and several large caps extended losses earlier in the session, but selling pressure has eased alongside Bitcoin's stabilization. What we're seeing now looks less like a cascade and more like a market searching for equilibrium after a sharp adjustment. Live price action throughout the day reinforces that idea. Instead of repeated new lows and expanding ranges, we've seen narrower moves, fewer liquidation spikes, and more two-way trade. That usually means leverage has been flushed, and the market is waiting for new information, rather than reacting to old headlines. That's why some of the more dramatic narratives circulating, claims that the bull market is over, or that this move marks a structural breakdown, need to be treated with caution. Those narratives tend to emerge right after fast corrections, not necessarily at turning points. What the charts are showing right now isn't capitulation, it's consolidation. And there's a big difference between the two. So when you zoom out and look at the full picture from the last 24 hours, what you see is a market that reacted sharply to macro headlines, repriced risk, absorbed significant ETF outflows, and then began to stabilize. Gold and silver benefited from fear flows. Crypto cooled as risk was reassessed, and now price is pausing to see what comes next. That doesn't guarantee a bounce. It doesn't rule out more downside either. But it does tell us the character of the move has changed, from reaction to evaluation. And this is usually the phase where patience matters most. Drop your thoughts in the comments, and as always, we will see you at the top.